Hello, everybody, and welcome to part 2 of our Module 12 session covering the topic of managerial accounting and cost. In this part, we're going to be covering the cost of goods manufactured statement as well as the variables and absorption costing income statements. So the first one we'll cover here is the cost of goods manufactured statement. Now, the purpose for this statement is to identify all of the costs incurred in producing and finishing products during this period. So when you see the word cost of goods manufactured, another way of thinking about that is the cost of goods finished statement. Those that are completed. That's the goal of this, because then this is going to move on to the cost of goods sold, where we need to know how many units we completed and how many units we sold. So there are a few different stages to this, and we're going to talk about a pattern that should help to clarify how this statement works. But first, we have to identify all manufacturing costs that have been used in the production throughout the current period. Whether we completed something or not, we first have to identify what costs did we add to production. That's the first step. Those would include direct materials, direct labor, and the manufacturing overhead that was applied this period. Now, I want to point out a distinction between the term manufacturing costs and cost of goods manufactured. This first paragraph, this first bullet point that we were talking about, that was the manufacturing costs. Those are the costs added this period, regardless of whether we completed the product or not. It's just the costs added this period versus the total costs of everything that we completed this period. So now I want to point out 3 different ways this could happen. You could have some products that we started last period, we added costs in last period, and then this period we added a few more costs and completed it. That's one situation. Another one could be we started a product this period and completed it this period. That's the easy scenario. The third scenario could be we started a product this period, added some costs, but we didn't complete it, and we won't until next period. So there are 3 different things going on. Ultimately, we're concerned with the total costs of anything we completed this period, regardless of when we started it. Any cost that went into that product that was completed, that's the ultimate goal of the cost of goods manufactured statement. But to do that, we have to look at a few different things. We have to look at, as we just said, the costs we added this period, the costs left over from work in process last period, and those are the 2 costs we have to work with. So we take basically the beginning inventory of work in process, the costs that were left over from last period, plus we're going to add in the costs from this period, but we're going to subtract out the costs of goods that were not yet completed. And that'll tell us what we apparently did complete. So that this little bullet point here, we're going to see this pattern in 3 different things, really. 2 in the cost of goods manufactured statement and 1 in the cost of goods sold calculation. This is the calculation for that. Now, I have some very general phrases here intentionally because it shows up 3 different times in 3 different things. But the calculation you need to remember is a beginning inventory of whatever we're talking about, plus the additions for this period. Some additions, if we're talking about materials, it would be cost of purchased materials. If we're talking about the actual units themselves, it would be the manufactured goods. So, and again, we'll see all of these in just a bit, but that's going to equal some sort of subtotal, either materials available, costs in process, or cost of goods available for sale, some sort of subtotal. But the point is, this is not the final number. Let's take materials, for example. Beginning inventory of materials plus the cost of new materials we purchased, that tells us the materials that are available, but that doesn't mean we used all those materials. We finished the product for those materials because we have some ending inventory left. So obviously we didn't finish that. We have to subtract that out. and that gives us the cost of materials that were used in production. That's the final number. After subtracting out the inventory, the ending inventory related to that item, we get one of these totals, depending on what we're talking about. So we'll see it in action here in this cost of goods manufactured statement. The first piece we're looking at, and let me show you, this first, I'd say almost 2/3 of the statement is trying to identify, right up to here, ending with this 23,500, it's trying to identify how many costs we added this period. We have materials, labor, and manufacturing overhead applied that we added this period. Now, materials, we have a calculation just for that, because we need to know how many materials we actually used in production. To get that, we take the beginning materials balance plus the purchases of new materials. This gives us the materials available for use, but we subtract out the materials we did not use, the ending balance, to arrive at the materials we did use. So all of that calculation was just to get to this $12,000 of materials that we used. Labor is easy. Hey, we used $7,000 of labor. There's no beginning and ending inventory to worry about. $7,000 of labor. Plus, we applied $4,500 of manufacturing overhead. Again, no crazy calculation there. So now we have those three costs, materials, labor, and overhead. That tells us the manufacturing costs that we've added this period. So I want to go back up here a second before we go any further. Let's take this material as an example. You know, we started with beginning balance and added in purchases. 10 plus 5 equals 15. There would have been no difference to that calculation if we started with purchases and added in beginning inventory. It'd be 5 plus 10. That still equals 15. So my point is, if you're adding two things together and you rearrange them, your calculation's still the same. The reason I point that out is that's exactly what we're doing for the second instance of this equation. That's down here. The cost that we added plus the beginning balance of work in process. Again, that would be the same as saying the beginning balance of work in process plus the costs we added, similar to what we did up here. But since we were in this subtotal, this $23,500 subtotal, it makes sense to start there. So the cost we added this period plus the cost we started the period with, beginning balance of work in process, this tells us the total costs that are in process. We ultimately want to know how many costs relate to goods that were finished. These are just costs that could potentially be finished. So the total cost in process, but apparently not all of them were finished because we have an ending balance of work in process. We have to subtract that out, and now that tells us we did finish $26,500 worth of cost. Now that gives us the cost of goods manufactured, which is the purpose of this statement. So there were two instances of this equation, one with the materials and then one with the in-process costs altogether. We've arrived at the cost of goods manufactured, the $26,500. Now we have the third instance of that calculation, and we're back to the original flow of that calculation. Beginning balance of finished goods plus what we've added to finished goods through the cost of goods manufactured, that number just flows over. That gives us the goods that are available for sale, but we didn't sell everything because we have an ending balance that we have to subtract out, and that arrives at the cost of goods sold, which of course goes on the income statement. So that statement, again, when you go through it, it seems like there's a heck of a lot going on, but if you break it into those three sections, it really makes it a lot easier to follow. So hopefully that helps to clarify that. Now we're going to go through absorption versus variable costing. Now the idea here is it really boils down to fixed manufacturing overhead costs. That's really the difference between these two systems. But the idea here is we know that product cost is important for both managerial and financial accounting because it relates to inventory, the cost of goods sold. That is really the main link between financial and managerial accounting. Inventory is. The information is very important to managers to help them set prices, control costs, just make decisions overall, evaluate management performance. They need accurate costing information. There are different methods of valuing the inventory on the income statement, and really, again, it all boils down to when do we count a cost as expensed versus it's just still an asset. That's the difference. That's the difference in purposes between absorption and variable costing. Variable costing is sometimes referred to as direct costing. So it's all a difference in which of those costs is considered product cost versus a period cost. And again, the only thing that's treated differently is fixed manufacturing overhead. That's the one that under one method is a product cost, under another method is a period cost. Every other cost that exists, it only falls under one of those buckets no matter what method you're using. And we'll see how that looks in just a bit. So you may question, why does it matter which method we use? And it's all about when do we count something as an expense versus when do we tie something to an inventory unit and then defer it until that unit is sold, and then we can expense it. Product costs are recognized as expenses upon the sale of the product, which might be a year later. Period costs are recognized as expenses that period, even if we haven't sold the corresponding unit. So again, fixed manufacturing overhead, we need to know under one method, it's treated as a product cost, and therefore it would be deferred. It won't be an expense right away. Under the other method, it's a period cost, and it gets expensed immediately. So back to all of our groups of costs. Direct materials, they're always going to be a product cost no matter what method we're using. Same with direct labor. The same with variable manufacturing overhead. Those are all product costs. They're all variable, and they're all product costs under both methods. Let's jump down to the bottom group. Variable selling administrative, fixed selling administrative. It doesn't matter what method you're using. Those are never product costs. They don't relate at all to production. There's no argument for them to be a product cost under any method. Fixed manufacturing overhead, it depends on the method. It does relate to production in general. Certainly, it's manufacturing, so it's a pretty easy argument to call that a product cost, but it doesn't really relate to an individual product, so some arguments would hold that that's actually a period cost, and under one method it's a period cost. So that's the one that's treated differently. And here you can see when we're focusing on product costs, under variable costing, that would be just the direct materials, direct labor, and variable overhead. But if we're talking about the absorption costing, it would be those same three, but it also absorbs a piece of the fixed manufacturing overhead. Every unit produced absorbs a piece of that fixed manufacturing overhead. That's where the term comes from. The term variable costing comes from the fact that only variable product costs are included as product costs. So the absorption costing method, by the way, GAAP, Generally Accepted Accounting Principles, they require this method. This is the traditional income statement that you're familiar with from financial accounting. It is the difference between above the subtotal and below the subtotal, which again the subtotal here is gross profit or gross margin. The difference between above and below is whether it's a product or period cost. And under this situation, under this method, every unit of product absorbs a bit of that fixed manufacturing overhead. So fixed manufacturing overhead is considered a product cost under the absorption costing method. And because the fixed manufacturing overhead and all of the other product costs, they're included with inventory, they only get expensed when that inventory is sold. So they're treated as an asset first. That's the difference. Fixed manufacturing overhead will be treated as an asset, and then eventually it'll be expensed. So let's take a look at an example between the two. Ready Steady Incorporated produced 1,500 bottles of this workout supplement shake. Each bottle has a direct material cost of $2.20, direct labor costing $1.75, and manufacturing overhead of $2.35 per unit, of which 85 cents is variable, and the other $1.50 is fixed. The selling price is $12 per bottle. That's revenue, not a cost. The selling and administrative costs are 65 cents per bottle, plus a fixed amount of $2,500 per month. So under absorption costing, if we're looking at the unit product cost, in other words, just product cost, not including selling and administrative, both methods would have those first three costs: materials, labor, variable overhead. That's all the same. Fixed manufacturing overhead, that $1.50 per unit, would only be under absorption costing, and it would be not applicable under variable because it would be a period cost there instead. So if we're just looking at the unit cost, the unit product cost, absorption costing has a $6.30 product cost, $4.80 for variable costing. So why does this matter? Let's look at the absorption method. We're comparing sales to units produced. Now, I will say, if we sell every single unit we produce that period, there's not going to be any difference whatsoever, net income-wise, between the two methods. The difference only comes up when we sell a different number than what we've produced. Either we sell less than we've produced, or in the next period, maybe we sell more than we've produced because we had some left over from the last year. That's the difference here. Now again, the income statement would be your sales minus your cost of goods sold, including both fixed and variable, to get gross profit, and then you'd subtract out your selling and administrative expenses, both variable and fixed. You'd arrive at your total amount. So the big point here is the product cost included that fixed manufacturing overhead, and remember the format is your traditional income statement format. In contrast, the variable method, let's take the same situation with the sales. Year one, we sold just exactly what we produced. Year two, we sold less than what we produced. We had some left over. And then year three, we sold all of those extra units plus the new units, so we sold more than we produced. So sales is going to be the same under both methods. But now notice the format is different. We're back to that contribution margin format from last chapter, where the subtotal is now contribution margin instead of gross margin, and then all variable costs are above that. Cost of goods sold and selling and administrative, they both go above the contribution margin, and both fixed expenses go below it. The fixed manufacturing overhead and the fixed selling administrative, they go below the line. So that's the difference here. Instead of having this manufacturing overhead be part of our cost of goods sold, it's down here as a period expense. The entire $67.50 is going to be expensed in that period regardless of what we sold. That is the key difference. So again, the traditional income statement, gross profit is our subtotal. The contribution income statement, the contribution margin is our subtotal. The net income will be the same overall, but it's going to differ in those periods where we sold different units. The amount is going to differ. And here's a good example of that. Same scenario there with our three different sales and production numbers. The variable costing net income is going to be equal to the absorption costing net income when we sold the same number of units that we produced. But when we sold less than what we produced, what we're basically saying is there are some of those units that had some of that fixed overhead absorbed into it that did not get expensed because they're not sold yet. So they're stuck as an asset. They did not get expensed under the absorption method, but they did get expensed under variable costing. So since variable costing has more expense that period, it's obviously going to have less net income than the other method. But then in the next situation where we sold more units than we produced, now all of a sudden all of that cost related to those units is going to come flooding in as an expense under the absorption method because we're selling all that extra product and now we're recognizing the expense. So there's more expense under absorption now and less net income compared with variable. But notice the 2 years offset each other. And now we'll go ahead and wrap it up with a nice comparison of the two different methods. So depending on those three scenarios, production equals sales, production is greater than sales, or production is less than sales, you can see how it impacts ending inventory, how it impacts the cost of goods sold, and of course, whatever it does to cost of goods sold, it's going to do the exact opposite to operating income. And then there were some various comments related to that. So hopefully this has helped to clarify these two important concepts, the cost of goods sold or cost of goods manufactured statement and the variables versus absorption income statements. So thanks for your time. I will look forward to talking to you in our next session. Have a good one.